Okay, good afternoon, everyone in Korea and elsewhere. We are resuming the conference now. In the morning, in terms of Korea, we had an opening ceremony followed by 5 presentations about the ESG. In the afternoon, we will have the one finance session with 3 paper presentation and 4 papers for the international trade subject. Okay. Now I'm resuming the conference in the afternoon session with first of all to Professor Mancho in KDI School of Korea. He is presenting the data economy and innovation cycle on international comparison. Professor Cho is my long-time colleague for about 30 years or more. And he has been focusing on the real estate finance and the digital economy. He has been serving for many international institutions and the housing organizations in Korea. Okay. He is currently in charge of the IAFICO as a president or chairperson of the board, which is one of our sponsor organization for this conference. Okay. Please welcome Professor Cho with warm hand.
Okay, thank you, Professor Jung. It is my great pleasure to share my research with the participants to this seminar. So let me first share the screen. Can I share screen from my end?
I think so. Yes.
Okay, let's try. Yeah. Okay, so the topic that I'm going to discuss in the next 20 minutes or so is about data economy. And this is the topic that we have been working on during last 6-7 months. In fact, what I'm going to present is a summary of findings from one co-authored paper with 3 colleagues of mine. Unfortunately, it is written in Korean, so I just extracted some key findings from that paper. And then the main thing that we did in this paper is essentially meta-analysis based on 2 data sets that contain the academic articles related to data economy in 3 specific sectors. We focus on those sectors in Korea: finance, real estate, and medical service. But I think the findings can have general implications to other countries as well. So with that, let's go into the outline of the presentation. The first, I want to spend a little bit of time to conceptualize what we mean by data economy. And then the next section, it's data economy's expected social effects. This is essentially a literature survey that we did to synthesize what are the key expected effects of the phenomena that we call as data economy. By the way, from around 2015, the academic studies on this topic are exploding in number. So we found a fairly large number of recent study on this particular topic, not only in economics, but also in medical and health and medical service and other fields as well. Then I will discuss the key analysis of the meta-analysis. Then the last section deals with policy implications and some concluding remarks. So I will finish my presentation by 12:30 at the latest. So introduction, in these slides, we are emphasizing that most countries, most large countries in the world are instituting the public policy to respond to the phenomena that we call as digital transformation. But I personally think it is not that well-defined concept. Data economy is in a sense a very similar concept to digital transformation, but I think it has a clearer economic meaning, as we will discuss in a minute. The main thing is not only the governments, but also the industries are experiencing a fairly fundamental change because of this phenomena of digital transformation. I'm not going to spend much time on this. So what is data economy? Well, this is how we define the data economy. We define it essentially as an ecosystem, an innovation ecosystem that generates socio-economic value either in a national level or in a regional level by efficiently distributing or trading digital data. So in order to do that, one has to collect, clean, maintain, and share digital data. So in this study, we try to examine how those three particular sectors in Korea, finance, real estate, and medical service, are doing in terms of creating this data economy ecosystem. Skip this. And then we believe that data economy is the underlying core concept to various terms that start with smart. You know, the smart factory, smart farm, even driverless car. In the service sector, we have a digital health, fintech, and insurtech. In the property market, we also have the area called as PropTech, property technology. And then in the public sector, we have a smart city and open government. All these initiatives share the data economy as the underlying concept. And then we believe the DPA, this concept called as DPA, which stands for Data Platform and AI, are the three critical ingredients of data economy. For that, I will come back to this point later on. Okay. Okay, I will skip some slides. And then we did a literature survey to extract key arguments from the literature. And as I said, there has been quite rapid increase in the volume of studies on this topic, on this particular topic that we call as data economy. And we summarize the main arguments from these literature into three groups. The first one is what we term as a platform effect. That's essentially about efficiency gain in intermediating certain service through platform and data. So that's one type of effect that I will try to elaborate in a minute. The other effect that we summarize is called as a prediction power effect. The more and better quality data can lead to the better prediction for optimal business model or production technology. That's essentially the arguments found in the literature. The third impact is the new analytics effect, which is almost all about AI. And thanks to the AI-based analytical methods, the scope of data that we can utilize has been broadening quite significantly from numerical conventional data to various non-conventional data, including satellite pictures, text, all those so-called unconventional data. They become within scope of certain data-based analysis. So let's take a look one at a time. The first one is a platform effect. For this, there are two so-called general purpose technologies that have been instituted from early 1990s. The World Wide Web, what we call as WWW, that was first introduced by the UK engineer in 1989. And in the US and UK, this internet-based platform development has started earlier than most other countries from early 1990s and mid-1990s. They have been developing various the internet platform-based services. For example, what we call as fintech today, that was actually started in the US from 1990s. So the innovation cycle has started earlier in those couple of advanced economies. Another big breakthrough in terms of platform-based service provision is the smartphone that was introduced around 2007. Then thanks to these two key innovations, there has been exponential growth of internet or mobile platforms. So the key implications of these the internet and mobile-based platforms that are documented in the literature are basically two outcomes. The first one is a dramatic reduction in transaction cost. So this is more like comparing going to the traditional bank branch to get the banking service versus doing the same financial service through internet or mobile platform. So intermediation efficiency has been gaining because of these platform-based services. There has been fair number of empirical as well as conceptual studies that document the extent of efficiency gain or the decrease in transaction cost because of these platform-based services. At the same time, these platforms enable to accumulate a lot of digital data through online transactions. So what we call as digital footprints. Whatever you do in online, in the internet, or through your mobile phone can be accumulated as digital data. Some of them are private data, so there will be a restriction in using those data. But there are a number of platform-based firms that put together those digital databases from the consumer transaction patterns in the internet. So these platform-based services also results in the rapid rise in accumulation of digital data from the online transactions. And then, some of these studies are the example. So in finance, because of these platform-based services, the phenomena called as disintermediation, the traditional financial intermediation based on the branches and human beings have been decreasing. So there has been a number of studies that document and discuss that phenomena. It is essentially same in real estate. Real estate, the transaction cost and search cost has been reducing thanks to the platform-based service provision. And also in the medical service, rise of remote or in-house medical service through platform that has been increasing in various parts of the world. The other one is the predictive power effect. So here, there is a fairly recent study, the NBR study, by a couple of MIT economists, and they showed the theoretical model that demonstrate that the accumulation of digital data will reduce the mean squared error or the prediction error in finding the optimal production technology, which will increase the productivity. The quality adjusted production will go up. And then one of the things that they claim is that this predictive power effect of digital data is generally larger when the data accumulation level is lower, or it is generally larger for the smaller firms like startups. That's their argument. And there are similar studies showing the prediction power effect of digital data in predicting business cycles, in assessing the firm risk such that user cost of capital can be reduced. And then because of the accuracy in risk assessment, the importance of collateral in the lending sector can also be reduced. So in the next slide, there are some more details provided that. And then the last effect I want to comment is the new analytics effect. So the AI-based analytical method, the machine learning and deep learning, they have been the use of those AI-based the prediction method have been accelerating during the last 5 years or so. And then there has been study, economic study that use satellite pictures to predict economic activity in certain geographical area, or use the text files, text data from the text filings to assess the risk of firms and classify the industry. And then we are seeing the new family of analytical methods. I listed these new methods, which frankly, I'm not that familiar, but there has been new analytical method introduced, as well as new softwares. R, Python, you know, those are the sort of a new analytical method. And then there has been a fairly interesting study in Journal of Economic Perspective, published several years ago. It's a survey paper of the machine learning technologies. And what they claim is that while the traditional econometric approach is generally top-down or deductive method that starts from theory. And then their focus is to confirm the sign and statistical significance of beta to prove certain hypotheses. Whereas these AI-based technology doesn't focus on beta that much. You know, from neural net, other types of new methodology can essentially be a black box in interpreting the beta, but they focus on error term, the mean squared error, to minimize the error term in predicting the left-hand side variable. So in a sense, the machine learning-based prediction is inductive, the opposite to the general approach of the econometrics. So they predict that in the long run, these two methods can be used as a supplement in academic research. And then I want to show the outcome of our meta-analysis. We processed about 260,000 academic articles on health and medical service. And then we selected 20 or so top keywords for every 5 years. And as you can see here, they are changing quite constantly. But during the last 5 years, from 16 to 2020, it's almost all about AI. The machine learning, neural net, algorithm, which is also related to AI, deep learning, and AI. Okay, so, and the concept deep learning did not exist 5 years ago. It's a new concept introduced fairly recently. What about finance and real estate? We processed about 26,000 academic articles related to data economy in the finance and real estate related journals. And in the last 5 years, we also have a number of AI related keywords, top keywords, deep learning. It's about 7/8 place. The AI is there, machine learning is there. In addition, big data is also ranked as a high, more frequent keyword. So what this shows is that in the recent 5 years or so, we are witnessing very rapid phase of AI-based analytical method being developed and being used. That's the main implication. As I don't have much time left, why don't I go into the key meta-analysis results. The first results we document is that the explosive growth of the academic studies from around 2015. So, yeah, I think. Yeah, this is the medical service related academic studies. And in fact, there has been two inflection points around 2003 and another one around 2015. That's the total, but it reflects what's going on in the US because US takes about 30% of all academic studies based on the affiliation of the authors. This red line is Korea. So in Korea, from around 2015, the number of academic studies is also increasing quite steeply. And this is the finance and real estate related academic studies extracted from Web of Science. Then the second observation we made is that this field is dominated by three countries, US, China, and the UK, in terms of quantity of research. So USA is a little less than 30%. China is about half, and then UK is a little less than half of China, and then Korea is ranked around the 8th place. So then this is the increasing growth pattern. This is a log transform. So Korea has a very low initial starting point, but the growth rate is fairly steep. Then another finding we had is there has been a fairly clear increase in co-authorship and multi-country collaboration. For that, this is the average number of authors per paper. I think this is the medical service. So it was around 1 in 1995. 2020, it's 4.5. So there has been steady growth in the number of authors. And multi-country authors has also been explosively growing in recent years. So these patterns were same in medical service and finance as well. So in terms of what's happening in Korea, there was virtually no international collaboration in medical science research until 2010. Then from 2011, during the last 10 years or so, there has been a lot more international collaboration in medical science. The last point I want to make is the quality dimension of the research is quite different. The quality dimension assessed in terms of average number of citations or the newness of topic. So for this, the average number of citation is better in traditionally more advanced countries. So number of articles, average number of citation, US is more than 20. Korea is 9.8, similar in China, but it's fairly high in UK, Germany, Italy. And then newness of topic, this is a little complicated issue. That's essentially what I want to report as a key finding from meta-analysis. Then we discussed some policy implications out of these findings. I don't think I have enough time to discuss those policy implications. I think, you know, we have just started the initial research on this topic, and I hope there will be more inter-country collaboration among Asian countries and as well as other areas. So why don't I stop there and then see if there is any question or remark, only if we have some time. Yeah.
Yeah, thank you, Professor Choi. Of course, you have some time for discussion or Q&A. Okay. Anybody from the floor? Yeah, Professor Cho introduced the data economy in real world and in research world, showing the inter-country, international difference in terms of quantity and quality of the research. Any questions or comment on the floor? Okay, then thank you, Professor Cho, for your presentation of data economy. Okay. Now it's turn to we are turning to the Professor Dr. Andy Chung Lo, the University of Wollongong, Australia. He is a law professor, in particular doing research on the Twin Peak supervision, financial supervision system, which is getting popularity in not only in Australia, UK, but also South Africa and the Netherlands, actually Korea potentially. So he's going to make a presentation or speech on the financial supervision system. Professor Chung Lo, please.
Thank you, Professor Jung. Colleagues, it's a source of great satisfaction to be able to speak to you about this today, because my talk today has a 6-year history with colleagues here in attendance today. In 2015, Professor Jung very kindly invited me to come to South Korea to talk about the Twin Peaks model and to explain to colleagues the benefits and the advantages of the Twin Peaks model. And I think at the time, there was some measure of consternation and perhaps some measure of surprise that I was very critical of the Twin Peaks model, because while I think that the Twin Peaks model is the optimal model for the regulation of the financial industry, for reasons I'll come to in a moment, we had seen very poor performance of the Twin Peaks model in Australia. And the reason why I say that it is the optimal model is because it's the only model that recognizes that there is a disparity and a tension between prudential regulation and conduct regulation. And we've seen elsewhere, for example, with the Financial Services Authority in the United Kingdom, and some of the outcomes from the Senate inquiry into the global financial crisis in the United States. We've seen that regulators that do both, that do conduct and prudential, Dr. Michael Taylor, who developed the Twin Peaks model, said, if regulators do both, you can be assured that they will do one of them badly. So I came to Korea in 2015 and again in 2017, I think, and again in 2018. And throughout that time, I've been saying that the problem with the Twin Peaks model in Australia is not the model itself, but the fact that our regulators, APRA and ASIC, have evidenced such clear evidence of regulatory capture. And my solution to that proposed problem was a board of oversight, if you like, a regulator to regulate the regulator, a board of oversight that would be critical, arm's length of the regulators, arm's length of government, independent of government, and whose purpose it would be to ensure that the regulators, ASIC and APRA in the case of Australia, were not captured, did not fall prey to capture, and held the industry to account. Now, this is a horse that I've been flogging for 7 years. I made a submission to the 2014 Financial System Inquiry to say that our regulators are captured and what we need is a board of oversight. The 2014 Financial System Inquiry in Australia accepted that recommendation and recommended the establishment of a board of oversight, which it was going to call the Financial Regulator Assessment Board, the FRAB. That was the only recommendation made by the 2014 Financial System Inquiry that our government rejected. And there's a backstory to the reason why it was rejected. It was rejected because the financial industry in Australia is very powerful, and it's very powerful in government, and it has a very powerful degree of influence in government, especially our current government. So the idea was forgotten, and I continued to raise my voice, and I continued to produce research in which I pointed out that our regulators are captured and that the only way to mitigate that capture would be through a board of oversight. That idea was not originally my idea. That is an idea that goes back to the 1860s, the writings of Charles Francis Adams Jr., who, writing in the 1860s, observed the capture of the railroad commissions in the United States. And his advice was that the only way to mitigate that capture would be to establish what came to be called a Sunshine Commission. And that term sunshine is an important one. Former Chief Justice of the United States, William Brandeis, once said, "Sunlight is the best disinfectant," meaning that public exposure of corrupt practices is the best way to end those corrupt practices. Anyway, things proceeded very badly, very poorly in Australia. We saw very significant examples of misconduct in the financial industry. We saw that our regulators, APRA, and in particular our conduct regulator, ASIC, were doing nothing about this misconduct. They were actively colluding with financial industry firms. And so the call began in Australia for a Royal Commission of Inquiry into why our financial industry was so rife with misconduct and why our regulators had performed so badly. That Royal Commission of Inquiry sat and held its deliberations during 2019, and it issued its report at the end of 2019. And what that Royal Commission found was that there had been very extensive misconduct in our financial industry, truly shocking levels of misconduct in our financial industry. Our financial industry was, and I think probably still is, rife with misconduct. And one of the things that the Royal Commission of Inquiry also found as a formal finding was that our regulators, ASIC and APRA, were deeply captured by industry. So the Royal Commission of Inquiry recommended that a board of oversight be created to watch over our regulators. The Royal Commission called it simply a board of oversight and recommended that one be established as soon as possible. This time, the government couldn't resist. There was so much evidence that our regulators had not been doing their job properly, and there was so much evidence of misconduct that had gone unpunished, that our government put forward a piece of legislation called the Financial Regulator Assessment Authority Act, the FRAA. And that act went before our Parliament, and it was passed by the lower house of our Parliament. And before it was passed by the upper chamber of our Parliament, I and two colleagues produced a research article in which we analysed the legislation, and we looked at the strengths and the weaknesses of that legislation. And we did so not just from a legal perspective. I'm a lawyer, and I took a legal perspective to the legislation, but one of the authors is a specialist in banking and finance, and he took a banking and finance perspective. And the third author is an organizational psychologist, and he took an organizational psychology perspective on the legislation. And we were critical of those places where the legislation was deficient. There were many places where the legislation was deficient, but probably the most important one was that our Treasury, our National Treasury, our Federal Treasury was included in the legislation and would have had a very important role in running this new board. And we explain in our article, which I've made available to Ms. Soyoung and is available to all of you if you want to read it, we explained in our article that it is absolutely essential that this Board of Oversight be independent of government. We were very fortunate in that we were able to be in touch with a very significant senator in the Australian Senate who represents the Greens Party, Senator Nick McKim. And we made the point very strongly to Senator McKim that the bill was deficient and that there was a risk that this new regulator assessment authority would also become captured. Now, the way our Parliament is structured at the moment, this changes from time to time, but the way our Parliament is structured at the moment is that the current government doesn't have a majority in the Senate. And so Senator McKim took our advice and he proposed amendments to the legislation which removed Treasury completely from the legislation. And that passed a vote before our federal Senate, and it was then referred back to the lower chamber, the House of Representatives. And thanks to COVID, the lower house was very preoccupied with COVID, and even though they had the numbers to reverse the amendments or reverse the changes that Senator McKim had put forward, they were too preoccupied at the time, and they simply passed the legislation. So we now have a regulator to regulate the regulator. That new authority has been established. This is the first time, to my knowledge, that this has ever been done in respect of financial industry regulators. It has been done in other forms that are somewhat similar. So, for example, in the United States, after a number of scandals revolving around how the audit profession was behaving, they established the PCAOB, which is usually referred to as the peekaboo. They established the peekaboo to monitor the audit profession and make sure that the audit profession did not become captured by the companies that they are supposed to audit. That is really the only comparable mechanism. But in terms of a regulator to regulate the financial industry regulators, this is the first time, to my knowledge, this has been done anywhere in the world, and I refer to this as Twin Peaks 2.0. So this is the most significant change to the Twin Peaks model since the Twin Peaks model was introduced for the first time anywhere in the world in Australia in 1998. And it's obviously very gratifying for me, having advocated and researched and argued for these reforms since 2014. It's very gratifying for me to see that these reforms have now been put in place. We are not out of the woods, I'm afraid. there is no guarantee yet that the Financial Regulator Assessment Authority will be successful. And that's because there were a number of other shortcomings in the legislation that we pointed out that were not amended. So, for example, the Treasurer, who is our Minister of Finance, has the power to appoint people to the board, which we think is unfortunate. And as a result, he has appointed as the chair of the board, the former Chief Executive Officer of one of Australia's most significant merchant banks, Macquarie Bank, a fellow by the name of Nicholas Moore. And I think that that is a great shame. Whether Mr. Moore tries to do his job faithfully or not, he will still come to the job with all sorts of cognitive biases. And those cognitive biases will favor the industry, favor the financial industry, and those may be reflected in recommendations that his board makes, which encourage our regulators to forbear, encourage our regulators to go soft on the industry. So we are not out of the woods yet, but we've certainly made great progress. And we looked at a number of different things, as I say, from an organizational psychology perspective. For example, we looked at the composition of the board. We looked at the value of mission statements and the empirical evidence that demonstrates the value of mission statements to keeping such a board true to its mission. We looked at the composition of the board, and we argued that for this board to be effective, there should be term limits on how long people can serve on that board. There should be term limits for how long somebody can be the chair of that board. There should be a requirement that the chair should rotate. There should also be a requirement that people be elected to the board through staggered appointments so that you don't replace everybody on the board all at the same time, which will enable a degree of institutional memory to develop. And we looked at a number of other issues that we thought would be valuable in preventing the kind of cognitive biases that we see creeping in and for which there's a great deal of evidence from a organizational psychology perspective. So to provide some more detail, the Financial System Inquiry, which was in 2014, recommended that this board be comprised of between 5 and 7 part-time members with industry and regulatory expertise, whereas the Royal Commission recommended only 3 part-time members. But the process of selecting members must play a very significant role in avoiding or minimizing the chance that this new oversight authority will also become captured. The 2014 Financial System Inquiry noted that undue influence from one stakeholder group could be mitigated, at least partially, through a code of conduct and through diversity in board membership. The process of appointing members to the assessment authority should also address the subtle ways in which the board may be influenced. So the inherent benefits and conflicts of appointing members with regulatory expertise and industry expertise, those need to be managed very carefully. And we think that it is desirable that people on the board should not come from industry and should not come from either of the regulators that are being subjected to oversight. And in terms of the potential for this board to provide insights and assessments that can be very valuable, we've actually seen in Australia a template for how this would be managed. So before this oversight board was created, and while the Royal Commission of Inquiry was underway, there was a capability review that was conducted of APRA, our bank regulator, and that capability review was conducted by an immensely capable and independent individual by the name of Professor Graham Samuel. Professor Samuel was chair of a different regulator, the Australian Competition and Consumer Commission, which is very widely regarded as a very effective and very meaningful regulator. He was the chair of that regulator, the ACCC, the Australian Competition and Consumer Commission. Excuse me. And Professor Samuel conducted a review of APRA, and his review was absolutely scathing. He found a regulator that is steeped in groupthink, where people who don't comply with the prevailing groupthink are ostracized and managed out of the organization, where the organization is deeply captured by industry. He interviewed people in the organization anonymously, one of whom said, for example, this organization, this regulator is so dysfunctional, we should shut it down and start again. And Professor Samuel's findings on APRA are on the record now, which means that next year or the year after, I think it might be next year, it might be the year after, I can't quite remember, when the new Regulator Assessment Authority reviews APRA, the public will be able to look at what the findings were in 2019 versus what the findings will be in 2022 to see whether the management of APRA has taken any meaningful steps to address all of the deficiencies in their organization. So we have seen that with the right people asking the right questions, we can achieve some very meaningful insights into how our regulators are behaving. And that will also be the case when this new authority evaluates the performance of ASIC, which is our conduct regulator. Apart from board appointments, it is very important, as I say, to select individual board members who don't have pre-existing beliefs or ideologies that would make them biased towards the industry or biased towards the regulators. And it's very important, obviously, that the agency itself recycles and refreshes that board membership in such a way that, for example, you don't have a chair who maybe fills the position for 10 years. If you have a chair that fulfills the position for 10 years, you will invariably have a situation where, for example, that person's prejudices or that person's biases imprint very heavily on the board itself and distracts the board from having a truly independent view. We think that the benefits to Australia of the establishment of this authority are very clear, and that they will enhance accountability and they will increase an assurance that regulators will be independent and will pursue their mandate and not be captured by industry and in the process financial crises. Of course, we all understand very easily that APRA, the bank regulator, we understand very easily that a prudential regulator has as its primary purpose the prevention of financial crises. But we've also seen in the aftermath of the global financial crisis that market misconduct and consumer abuse as a prime issue, that can also have a system stability implication. So we think that this accountability, this enhanced level of accountability, will speak to the core of the democratic and parliamentary endeavour. As Ross Levine, a very prominent scholar in this field, he and his colleagues, Barth, Caprio and Levine wrote a book in 2014, published by MIT Press, called The Sentinel, The Guardians of Finance, in which they also proposed a regulator to regulate the American regulators. And Levine makes the point that, as he puts it, and I'll quote, he says, no existing entity has the prominence, information, and expertise to challenge major regulatory agencies on financial policy matters. A monopoly on regulatory power and information is dangerous, particularly when it is housed in an entity that is independent of the public and independent of elected representatives. A monopoly on financial information, regulatory expertise, and regulatory power in unaccountable hands breaks the democratic lines of influence running from the public to the design and execution of policies that determine the allocation of capital, end quote. So we're of the view that regulator accountability is a vital component for the efficacy, not only, but indeed especially where regulators forbear in the exercise of their power, as often happens in conditions of regulatory capture. By forbear, I mean do not enforce their mandate against firms that commit misconduct. We also think there's a benefit to be derived from a formalized mechanism of independent, arm's length, and recurring assessments of regulator efficacy, which could disrupt the predictable life cycle of regulatory agencies that are referred to in our article, which I've made available to Ms. Soyoung. Oversight from highly experienced individuals appointed for a fixed term and independent of the regulators and independent of the entities that they regulate would be able to provide recursive reviews that would continually measure regulators against their mandates, and in so doing provide a more fixed benchmark against which to make that measurement. Accordingly, the introduction of an assessment authority in Australia, we think, will serve as a very timely and effective adjunct to the current Australian Twin Peaks financial regulatory architecture. But in order to give this new entity the greatest prospects of success, the shortcomings that we have identified in our article, not just in the specific legislative provisions, but also in the ways in which the assessment authority is conceived, should be addressed. And we hope that they will be addressed in time, perhaps especially if there's a change of government. We think that regard should be had, again, not just of the legislative provisions, but rather for the totality of the task set for the assessment authority, which is to address an insidious problem which is as old as the regulatory craft itself. And that insidious problem, as old as the regulatory craft itself, is capture. So watch this space. I'm sure that there will be opportunities for me in the future to report on the efficacy of this assessment authority, and I look forward to communicating those results to you, my colleagues, in future. And perhaps this will become a template that can be used elsewhere. In Korea, in the United Kingdom, we've seen failings by the Financial Conduct Authority in the United Kingdom. And there were reports that were issued at the end of last year, one by Dame Elizabeth Gloucester, the other by Mr. Justice Raj Parker, which pointed to serious failings and deficiencies in the way in which the United Kingdom's FCA, Financial Conduct Authority, has discharged its mandate. And there are certainly implications of regulatory capture underway there as well. So hopefully this will be a positive development, and hopefully this will be the beginning of a mechanism to break the cycle of regulatory capture. My thanks to Professor Man Cho and Professor Jung, who have provided me with such tremendous support over the last 6 years to put these ideas forward, and to help me to articulate these ideas and to help me to refine these ideas. And there's no doubt that the support from Professor Cho and Professor Jung have assisted me, which in turn has enabled me to make effective representations to, for example, the Royal Commission. And so now we have a regulator to regulate the regulator. So thank you very much indeed. Kamsahamnida.
Okay, thank you, Dr. Shunlo. As you said, Professor Cho and I may have supported you for 7 years, but another 7 years will be waiting for you. Any question from the floor?
Actually,
Okay.
can I ask? I
Yeah,
have
go
a
ahead,
couple of
Professor Shaw.
questions.
Yeah.
The assessment authority that you described, will that organization supervise both peaks? In other words, prudential regulator as well as conduct regulator? That's my first question. Then, in Australia, I presume that this issue of regulatory capture emerged as an important public policy problem, such that it led to the organizational change. So I wonder through what process those regulatory capture issue has surfaced in Australia. Is it sort of media coverage, prosecution, or I'm asking that because this would be a quite universal problem in the financial service sector. So I wonder how it became such an important public policy issue. Well, I have one more. That is, if you create another regulator who supervise regulators, then can they also be captured somehow in future?
So thank you, Professor Cho. So in answer to your question, the new assessment authority will have oversight over both regulators, APRA and ASIC, and will assess their performance in alternative years. So 1 year it'll do ASIC, and the next year it'll do APRA, and then back to ASIC. In terms of how the regulatory capture was exposed, it was exposed in a number of different ways. It was exposed extensively in the media. It was exposed in the 2014 Senate inquiry into Commonwealth Bank financial planning. That Senate inquiry was conducted in 2014. That was the first time there was a formal call for a royal commission. The Senate inquiry found they described ASIC as weak, feckless, and suborned. They were extremely critical of the way ASIC had performed. And then, of course, there was evidence that came before our royal commission, evidence of how the regulators had constantly negotiated with firms that had committed misconduct. Instead of enforcing the law, instead of prosecuting them, instead of taking them to court, they would negotiate enforceable undertakings, which were nothing more than a slap on the wrist. They would issue press statements, for example, criticizing a bank for its misconduct. But before they'd issued the press statement, they would go to the bank and they'd say to the bank, are you happy with this press statement? If you're not happy with this press statement, let us know where you're not happy and just tell us how you want us to change it, and we'll change it for you. And in fact, one of the things that the Royal Commission said in its findings is it said ASIC must stop treating regulated entities like clients. They are not clients of ASIC. They are entities to be regulated against whom the law must be enforced. So the Royal Commission made a very firm finding that ASIC had been had started to assume the role of a kind of a servant to the industry, that ASIC had stopped enforcing the law, that ASIC was constantly going out of its way to make people in the industry satisfied and not one point that I've been made years now is that I borrowed very heavily from the Public Service Act. Is that the right name of the legislation, the Public Service Act in South Korea? I know there are deficiencies with the Public Service Act. Is that the right name of the legislation that prevents the revolving door? That is the right name. So I've been telling people in Australia for some years now, look to what has been done in South Korea. Look at how South Korea has passed legislation to close the revolving door, to say to people who have been regulators, you are not allowed to go and work for a regulated entity within 3 years of leaving the regulator. And I've made the point that as far as the legislation is concerned, it doesn't matter which regulator you work for. If you work for the healthcare regulator, you can't go and work for any other kind of regulated entity like a bank. Now, I know that there are deficiencies, and I know that there are opt-out clauses, and I know that there are exclusion clauses in that legislation. And I know from colleagues at IAFICO that there's a great deal of criticism of the Public Service Act, but at least it's a start. So that's my answer to your second question, Professor Cho. My answer to your third question is absolutely there is the risk that this new board of oversight could also be captured, which is why we argued so forcefully to Senator McKim that Treasury must be removed from the legislation, because our Treasury, which is a government department, our Treasury takes its orders from the Treasurer. And the Treasurer is one of the most senior members of government. And the current Treasurer is a former banker. And our current Treasurer has done all sorts of very strange and suspect things in the time that he's been the Treasurer to favor the financial industry. So we wanted to cut that line. We wanted to prevent the Treasurer from being able to interfere in the board. And we see that if the board has the right people, like Professor Graham Samuel, then it won't be captured. It will expose capture. My concern is that the new board will not be led by Professor Samuel. It will be led by a former chief executive of a very large, very prominent bank. And that is not a good sign. So, you know, the expression Rome wasn't built in a day. You know, the expression 2 steps forward, 1 step back. We've created 2 steps forward. We've created this board. We've removed Treasury. I am very dissatisfied to see that a former banker has been put in charge of this board. And I am confident with my connections with members of parliament, not connections with members of parliament in the current government, but members of parliament who are in the opposition, the Australian Labor Party and the Greens. I'm confident that if they were to win the next election, that they would be amenable to arguments to remove Mr. Moore as chair of this board and to appoint someone who is beyond reproach, someone like Professor Graham Samuel. So yes, the danger is there. We're not out of the woods, but at least we're moving in the right direction.
Thank you.
Okay, thank you, Andy. I hope the Australia will be happy to enjoy the new system of the regulator's regulator.
Thank you.
Australia is a great country which developed the twin peak system in the world, which Korea is trying to mimic.
Well, hopefully we'll work out how to do it properly. We used it first, but we haven't been using it properly. So hopefully we'll work out how to use it properly. And in that regard, as I say, I am making sure that the things that we can learn from countries like South Korea and the way in which you've tackled the revolving door, that we absorb that information. Of course, having lobbied Senator McKim to remove Treasury, I have to accept the fact that I won't be getting any Christmas cards from Treasury.
Yeah. In fact, Korea also developed the prosecutor's office of the prosecutor this year. Interesting, yeah.
Right.
Yeah.
That is very interesting. Thank you for letting me know that.
Yeah, I guess the Australia is approaching to summer in Southern Hemisphere, which is opposite in the Northern Hemisphere, like the ASEAN countries. Now, we are 10 minutes behind the schedule. So we are moving on to the next speaker, Professor Satoshi Nakaide the Waseda University. He is speaking about insurance law, which is his major. Okay. Satoshi Nakaide is an insurance law professor at Waseda University, particularly majoring in the ocean marine insurance law, I guess. So please welcome Professor Nakaide.
Hello, everyone. My name is Satoshi Nakaide. Can you see the slides?
Yes, we can.
Okay. So I'm now teaching insurance, marine insurance, and others, and especially on the marine insurance law and also insurance system, and also some regulations and mechanics of insurance system as a whole. And also I'm interested in some consumer protection as well. And today I would like to make a presentation on the exclusion clause in the insurance contract. As you know, the insurance is a very complicated product, financial product. But the most important core issue is whether or not the claim is covered by the insurance. And there are lots of clauses, and many issues are on whether any exclusions are applied or not. So always there are lots of litigations and claims, and also criticism against insurance, and they relate to some kind of exclusion. And so exclusion clauses are so important. So I would like to discuss some of the nature of exclusion clauses, what's their nature, and how does the exclusion clause insurance is different from the other exclusion clause in other contracts. And there are lots of literatures and extensive research on the exclusions, but mainly these are on particular issue and particular peril, whether willful misconduct covers this or not, or what is the meaning of willful misconduct, or the scope of willful misconduct, for example. So there are lots of the researches and litigations on this, but little discussion on the legal nature of such clauses in general. But there are some discussions on the exclusion clauses based on unfair contract and terms, especially in EU and in Germany. But in general, general arguments are not so much. But I noticed some interesting statements in one of the law on civil law in Japan. The professor Shiomi says that the insurance exemption clauses used in many contracts are one of which exempts the party from liability once liability has been established. But in insurance, exclusion clause does not exempt the insurer from liability once the insurer's liability has been established, but relates to the scope of the insurer's coverage. So this means this is a part of the content of the insurance cover. But unfortunately, this statement was deleted in his next book. So I wonder whether he is confident on it or not. But it's very interesting, and I would like to argue this here. But when we are dealing with exclusions clauses, there are lots of various clauses, and there are lots of various wordings for it. And one in UK and maybe in Australia as well, the typical wording is exclusion. And exclusion is, for example, this insurance excludes certain peril like willful misconduct or earthquake. And there are also some terminologies, exemption. So insurers are exempted from liability for willful misconduct or so on. And also no coverage. For example, insurer does not cover certain risks, including willful misconduct. Or no payment. Insurer does not pay for the loss caused by willful misconduct. And also no liability. Insurer is not liable for the loss caused by willful misconduct. And also there is a warranty, especially in UK and common law states. Warranty is widely used. The insurer is warranted from paying loss or damage while the vessel was outside the routes. Well, so like this way, there are many expressions for the exclusion clauses. So we have to examine the effect of these wordings minutely when we are discussing. But in general, I would like to make some discussion on this. And as an example, we would like to look at some Japanese insurance law. Japanese insurance law is the act enacted in 2008. And this is the basic law covering the contracts, the rules for the contract. And that is the article on exemption of insurer. The Article 17 states that an insurer shall not be liable to compensate for any damage that occurs due to the willful act or gross negligence of a policyholder, etc. So in essence, is it exemption of liability, or rather, is it an exclusion of the certain risk in the coverage? The wordings just states they are exempted from paying from liability, but contents, I think, is the exclusion of the risk. And then I would like to go to the international cargo clauses. This is the very common international marine cargo insurances. As Professor Honjo stated, I'm specialized in marine insurance. And this institute cargo clauses are very widely used in Asian countries as well. So actually, this is a global standard for international cargo insurance. And in these clauses, it states the risks. This insurer cover all. This insurance cover all risks of loss, except as excluded by the provisions of clauses 4, 5, 6, and 7. And there are lots of exclusions, and these are just a part of exclusions. So like this way, there are lots of exclusion clauses. So the question comes to the meaning of exclusion, but this is a common understanding in Japan that this is one definition by the professor Yamashita. He's an authority on insurance law. And he says, exception in insurance contracts are exceptional events for which the insurer is not obliged to provide insurance benefits, even if the facts corresponding to the insurance accident occur. So he said, these are exceptional events, but is it exceptional? If so, what's the meaning of exception? So I wonder if this statement is correct or not. And when we look at the judges and academic arguments, there are many statements that exclusions in insurance policy are disadvantageous for policyholders. So because of this, judges tend to interpret them narrowly and apply them restrictively. And academics argue that exclusion clause is a clause protecting insurer and should be interpreted restrictively to narrow the scope of the exclusion. And various exclusions are introduced to protect the insurers like this way. So consumer protection is important. However, is the exclusion clause benefits the insurer and is disadvantageous for policyholders? In my opinion, advantage should be judged based on the coverage and its premium. So to argue this, I would like to make some comparison with sales or other services contracts. And in general, there is some duty to provide goods and perform services. This is, I stated, A. So at first, there is a duty to provide some things, to perform service for the carriage and so on. But if there is any failure of this duty, then there will be a liability. But certain liability are excluded or exempted or limited to restrict the liability of the negligent party. So like this way, usually this comes A, B, C. But when we are thinking about insurance contract, what is the liability of insurance contract? I think the insurance contract payment and paying benefits to the assured is the main duty of the contract. And to show the boundary of duties, they say this is a coverage area and this is exclusions. So this means that the coverage minus exemption is the duty. So like this way, insurance exclusions are completely different from the general exemption in the contract. But if there is any negligence on the part of insurers, such as the late payment of insurance claims, so this means the breach of contract and insurers owes damages for it. So in such a case, the structure is just ABC. A is the duty to pay insurance claims, and B is the damages for the late payment because of the failure. And C is, in certain cases, their liability is excluded. So in this way, so you will understand the difference between insurance contract and normal damages or liability. So when we are comparing advantage or disadvantage or merits or demerits and so on, we have to compare with the situation A and B. In the situation of A, coverage is a blue area, insured perils, but certain risks are excluded. But for B, these are all insured. So then let's think about premium. Of course, premium should be lower than B. A's premium is much lower than B because they are not liable for exclusions. And for B, insurance premium might be larger because insurers may put so much high premiums for the excluded perils, or in sometimes they do not underwrite a certain risk because it's too risky. So for example, for life insurance for longer terms, for unlimited time until the death, in such a case, if there is no exclusions for war or civil commotion or riots and so on, then insurance premium would be higher than the situation where it contains exclusions of war or something like that. So you will understand the coverage and premiums are balanced. So we have to think about this combination. So I would like to make the comparison in general contract. This is the providing goods and services, as I said before, and payment is for the non-performance of the duty. But in insurance contract, payment is a purpose of the contract, And this is based on the law of large numbers, and it is necessary to limit and clarify the cover because it's important to calculate premiums and making some prediction for the occurrence of risks. And scope of coverage can only be stated by showing limitations as well. So in this sense, I think exclusion is not exceptional because it's just the statement of coverage. So my view is there are various exclusions clauses in insurance, but they are limited. They are used to limit the scope of coverage, which is necessary for insurers to underwrite the risk. So it is inappropriate to understand them as exempting the insurer from liability already legally arose. So this is very much different. So it is not appropriate to immediately regard it as a clause for the protection of the insurer or defense of them. So scope of coverage is directly linked to insurance premiums and the availability of insurance. The exclusion clause should not be evaluated without regard to these factors. But there are certain situations where such clauses are disadvantageous for the policyholders. I think the first is the situation of the unclear wordings and so on. So important thing is the clarity and transparency of the clause. So when the meaning and its effect of the clause are not clear, or when it goes beyond reasonable expectations, in such a case, I think the purpose of the contract is to pay insurance money for the action occurred. And this is the quality of the product itself, and it is the essence of insurance. So if a clause lacks this, its validity should be denied, or it should be made restrictive interpretation. And I think this is very important. It's a kind of product liability. Insurance is also, if there is some unique exclusion clause and which gives a much big effect beyond reasonable expectation, I think it is a defect of the product. So it should, such kind of clause should be narrowly interpreted. And I think this is common to all insurance contracts, regardless of whether they are for consumers or not. And second is the complexity and difficulty of understanding wordings. And wordings need to be understandable by policyholders. And in this sense, for consumer insurance, the understandings or the knowledge and ability of the consumers is very important. So in this area of insurance, wordings should be easy to understand for the consumers. And consumer protection is very important in this regard. I think these are a little bit different. One, clarity should be applied to all insurance, to business insurance like money insurance. But two, second one is particularly important for consumer insurance like life insurance or automobile private insurance. So anyway, my argument is that many lawyers or judges tend to regard exclusion clause as some kind of bad one and disadvantageous. But I think this argument is not logically sustainable. I think we have to separate arguments. The essence of exclusion clause in insurance is to make it clear the scope of coverage, not exemption of legal liability in other types of contract. So it is not something that should be evaluated as exceptional. This is a normal things for the insurance coverage. Exclusions are necessary to make the insurance and making clear boundary for the coverage. But at the same time, clarity and transparency of the clauses are very important and necessary. So, and it must be understandable by policyholder. In this sense, we have to be careful for the consumers as well. So if not, the clause needs to be invalidated or interpreted narrowly. So from this sense, insurers need to draft clauses to satisfy this. But my argument is we have to separate the argument between these. So this is my at the end of my presentation. Thank you very much for listening.
Okay, thank you, Professor Nakaide. Professor Nakaide introduced the idea about the insurance contract exclusion, which may be beneficial to consumers rather than damaging their status or the right. For probably economic reason. Okay.
Yes, thank you very much.
Yeah, I think it's similar to our dinner menu, which is a number of course menu, which is doesn't meet our need. Okay. Sometimes we want to discard some part of the menu for better discount. Okay. Any question from the floor?
Professor Chung,
yes, go ahead. Yeah, go ahead, please.
ค่ะทิติวดีค่ะ Professor Nakaide. Thank you for your presentation. I think that it's a very good topic that in Thailand we also debating a lot on the it's not an exclusion, but it's some kind of the clause that in the insurance contract that, for example, we right now we have some problem about the issue of the policy to cover on the COVID-19, that if the people died from the COVID-19, the insurance will pay for the payment. However, on the clauses that they stated, it's like if such an insurer is in the coma situation, so it's kind of the unclear that what the definition of the coma. So it's like debating between the insurer and the insurer. So do you have any comments on that?
Thank you very much indeed. It's difficult for me to comment on the interpretations of the exact wordings of in your country as to the COVID-19, but I think there are lots of litigations in the world as to the coverage issue on the COVID-19. And I think there are lots of ambiguity of the wordings and so on. So the scope and the influence, what's the influence, or whether or not what is the cause of the death, or causation, and so on. So the issue are very much complicated, but I think wording should be clear. So from my point of view, not only the meaning of the language, but also the effect of the clause should be clear. So if not, judges need to restrict their interpretations. So this means cover accidents and so on. And I think in UK, there are a test case by the House of Lords, the Supreme Court, and there was issues on the COVID-19 coverage, but judges made a decision to protect the claimants for asking insurance payments. Well, insurer denied liability, but the wordings were not enough to deny liability or so on. So, of course, insurers will say we wanted to restrict such kind of risks, but I think it is fair. It's okay to limit risks, but if they want to do so, they need to think about the good wordings for it. If not, such clauses cannot survive.
Thank you so much. Yes.
Okay, thank you. Okay, with that, we'll conclude the Professor Nakaire's presentation and the Q&A session. Now we are moving again to the next presentation of Mr. Ki-young Kim on the multi-stage markup analysis of long-term care in Korea.
Thank you very much, and Honjo and the audiences. So,
okay.
Bye-bye.
Okay, see you again.
Hi. Thank you.
Okay.
Thank you.
Okay. And Mr. Kim Hee-young used to be a data scientist serving for SAS Korea and the major insurance company. Now he's taking his PhD course in SKKU. Okay. Please welcome Mr. Kim. Yeah, please turn on your microphone, Mr. Kim.
Can you hear me?
Yeah.
Oh, okay. Can I start first?
Yes, you can.
Yeah. Yeah. My topic that I'm going to share with you today is that a study on the multi-stage Markov model of dementia in elderly people, which is empirical evidence from Korea. And before starting, I would like to give a brief introduction of my career. My name is Ki-young Kim. Most of my career is related to analytics, and I also have an experience in insurance companies such as Chubb Korea and Cigna. I'm doing business with machine learning or AI technique in the insurance area. Okay, let's get down to the topic. Today, I have prepared 4 agendas. Firstly, introduction about my study. Secondly, literature review and model framework in my study. After that, I'm going to share the result of analysis and findings, and then our conclusion. Introduction. As you may know, Korea is one of the fastest aging society in the world because of the demographic change and population aging. The long-term care for the elderly people will be a big burden to nation as well as individual. Among geriatric care, the dementia care will be the top concern due to the fast-growing dementia population in need of LTC. However, the lack of knowledge about the frailty level transition of geriatric illness like dementia is an obstacle to develop the proactive solution, which could lead to decrease the number of supporting by family. And it has also slowed down a flexible approach to insurance solution that complement existing social insurance. The bottom table shows that the prevalence rate of three major geriatric diseases, dementia, stroke, and Parkinson. As you see, dementia prevalence rate is increasing as seniors' age is growing, whereas stroke or Parkinson doesn't show growing trend continuously. So this research aims at identifying the key factors of impacting on the state transition of dementia at each frailty level using survival analysis and developing a transition probability model by parametric approach. For this research, I used empirical data from Korea National Health Insurance Service, NHIS. First of all, I assessed the key drivers impacting on the transition from one state to others using Cox proportional hazard model and accelerated failure time model, which is the parametric model. And secondly, I estimated the persistency rate as seniors are getting older at a certain frailty level using parametric model, which is AFD gamma. Lastly, I estimated the final transition probability from previous frailty level to other levels as a form of Markov transition. From my review of previous literature, many researchers proposed a semi-Markov process to measure the covariate effect on the transition between different frailty levels. The results showed that age and sex or gender are significant to the transition. And some literatures mention that several covariates like household type, living type are significant driver to the transition. However, these studies have a limitation of data availability. There are only a few applications based on real long-term care or longitudinal data. For my study, I set up the multi-state Markov framework to measure the corporate effect on the transition of frailty level like previous literature. When it comes to dementia frailty level, I separate into three groups by cognitive disorder level, which are mild, moderate, and severe state, and add two more states. The autonomic state and death. So there are total 5 states. In this multi-state framework, I assume that there is no backward direction and transition process because once dementia occurs in senior people, there is no complete treatment. The best way of medical cure is to make it slow down. Because of this, no backward direction is a reasonable approach, I think. In this study, I tested the 3 hypotheses based on semi-Markov framework. Hypothesis 1 is that demographic factors would impact on the state transition. Hypothesis 2, socioeconomic factors would impact on the state transition. Hypothesis 3, underlying conditions and existing geriatric disease would show the difference in cognitive state transition process. For these hypothesis testing, I defined 10 candidate factors. Age and sex demographic factors, income level, residential area, household type, living type, which are socioeconomic factors, and stroke Parkinson, and diabetes and hypertension, which are existing geriatric disease and underlying condition. And this is the proportional hazard model result regarding state 1 transition from autonomy to others like mild, moderate, severe, or death. Among 10 variables, 9 factors are significant in this state, and there is one interaction effect by age and sex on the transition. On the right side, I summarize the result. Firstly, dementia, Alzheimer's disease is more likely to occur in women than men at the same age. From the result, if one age unit increasing in senior group, the hazard ratio of female is 5% compared to 3.7% in male. Second, no history group of stroke, Parkinson, and diabetes show lower risk of dementia occurrence compared to the history group. Number 3, when it comes to dementia occurrence, there is no difference between the high level of income group and low level of income group. And fourth, senior people who live in big city like Seoul have a little higher risk in dementia occurrence. And I also analyzed the covariate effect on state 1 transition with parametric AFT model. The result shows that the interaction effect by age and sex is significant. The coefficient of age variable has positive direction in male group, which means male is more likely to stay in state 1 against the female at the same age. Second, the history of hypertension has no effect on transition, as PH model shows. The interpretation in terms of hazard ratio in PH model and coefficient in AFT model, you can interpret it like this. If hazard ratio is more than 1, the risk of transition is higher than reference or baseline in PH model. In AFT model, if the coefficient of positive direction, the risk of transition is lower. This is the result regarding state 2, transition from mild to moderate, severe, or death. In mild state 2, the interaction effect by age and sex is not significant, which means there is no difference between man's risk and woman's risk at the same age. If one age is increasing in senior group, the hazard ratio between men and women has the 3.5% of transition risk. Second, the overall man has the high risk of transition than man due to the gap of life expectancy. 3, no history of hypertension group shows the higher risk of transition to the worst state. Number 4, no history of diabetes group shows the lower risk of transition to the worst state. The AFT model result shows that there is no interaction effect by age and sex. And second, the history of hypertension group has a negative coefficient significantly. It means that the no history group is less stay in state 2 compared to the history group. this is the result regarding stage 3, transition from moderate to severe or death. In a moderate stage 3, the interaction effect between age and sex is not significant. The result shows that if one age increase in senior group, the hazard ratio of men and women has the same at 3.4%. 3.4%. In moderate stage 3, man has a higher risk of transition than that of women due to the gap of life expectancy. 3, top 30% of income group doesn't show any difference transition against the lower 70% of income group. The AFT model result also shows that there is the interaction effect by age and sex does not show a significant level consistently. In AFT model, living type with the facility or hospital has a significant positive coefficient, whereas pH model doesn't show any significant level. Lastly, in severe state 4, in severe state 4, the interaction effect between age and sex is also not significant. If one age is increasing in state 4, the hazard ratio of men and women has the same at 4.1%. In severe state 4, male has a higher risk of transition that of women due to the gap of life expectancy. In AFT model, the interaction effect by age and sex is not also significant. In AFT model, sex variables is not significant in contrast to the pH model. Yeah. This is the summary of significant variables impacting on the transition at each frailty level. As you see, the interaction effect by age and sex is significant in only state 1, which means the sex or gender gap exists in dementia occurrence. However, after the occurrence of cognitive disorder, sex or gender gap is not anymore effective on deterioration of dementia. This time, I'm going to show you the estimation of state persistency at each frailty level. This graph shows that state 2's estimated persistency rate at the inception of 70 age by AFT KARMA model. As you see, 70 men's estimated persistency rate depend more than that of women in state 2. In state 3, 70 men's estimated persistency rate shows steep slope compared to the state 2. And also you can identify the difference between state 2 and state 3. And in state 4, both of 70 men's and persistency rate and 70 women's persistency rate shows a steep slope, and you can identify the difference between these states, state 2, state 3, state 4. Okay, this slide shows that the difference at the inception of 70 age, 75 age, 80 and 85 age, which came from AFT KARMA model. As you see, as age is growing, the persistency rate is decreased more quickly in both men and women in stage 2. In stage 3, the persistency rate shows a big drop as age is growing, especially in men's group. In stage 4, the persistency rate shows a similar pattern in stage 3. And also you can identify the difference between these the different states, stage 2, stage 3, and stage 4. Okay, this is the final estimation of transition probability as a form of Markov transition. After time passed fully, the estimated transition rate from stage 1 is 22.6% to stage 2, 24.2% to stage 3, 24.2% to stage 4, and 29% to death. From stage 2, the estimation of transition is 33.7% to stage 3, 29.9% to stage 4, and 36.4% to death. The estimate transition rate from stage 3 is 44% to stage 4 and 56% to death. Okay, this is the conclusion of my study. As you know, due to the limited data availability, most literatures on dementia cannot account for the duration effect on the transition between different states of cognitive disorder. In this study, I identified the key factors to impact on transition based on semi-Markov framework with the senior cohort longitudinal experienced data from Korea NHIS. From the survival analysis, I found that age and sex variables are significant at every frailty level. And dementia is more likely to occur in women than men. However, after occurrence, there is no gap between men and women. Persistency estimation by FT model can give very important information of expected LTC duration time at each frailty level. And finally, we can measure the expected number of senior in need of LTC by dementia using estimated transition probability table. Yeah, that is all I prepared for today. Thank you.
Okay, thank you, Mr. Kim. Similar to Mr. Kishi in the Chulalongkorn University in Thailand, Mr. Kim made a presentation out of his doctoral dissertation on the same topic. Okay. As you have seen, Mr. Kim is also still young and energetic and fluent in English. Okay. Anybody got a question from the floor? No? Okay. Okay. Thank you again, Mr. Kim, for your wonderful presentation.
Yeah, thank you.
Okay, now we wrapped up the first afternoon session on financial issues. The next session will be about the foreign trade, which the session will be moderated by Dr. Lee Yoon.